Hello, everyone. Thanks for joining us for the Market Huddle on November 2nd, 2018. This is still our pilot episode. My name is Patrick Ceresna.
And I'm Kevin Muir. This week we're going to be talking about the stock market, the high-yield bond market, this week in 1929, and we're also going to have a good story that Patrick's going to share with us of Nortel way back in the day. And finally, we're going to end with the 5 things to watch this next coming week. But before we get to that, let's talk about our sponsor. We're pleased to announce that Thornbury Village Brewery has actually sponsored us this week. And it's Ladder Run beer is what actually we'll be drinking. So, Patrick, cheers.
Cheers. So tell us the story why you chose this beer.
Oh, sorry. I saw Ladder Run, and, we did have a lot of different sponsors that were kind of vying for our business, but when I saw the name of this beer, Ladder Run, I just couldn't help but think of the stock market and how it's been going up in a ladder. And I thought with the recent decline in the stock market, maybe this is a final beer to drink after the ladder is finally kind of hit the top.
Oh, fantastic. All right. Well, I'm going to have another sip. It's actually a nice beer.
Yeah. So before we do this, let me just get into my lawyer compliance stuff that I need to do. So here we go. Clients and employees of East West Investment Management may hold positions in securities mentioned in this podcast. Nothing in this podcast should be construed as investment advice. Listeners should consult an investment professional before making any decisions about topics mentioned in this show. For more information, please visit eastwestfunds.com. And don't forget also that listening to this show might cause hot dog fingers, dry mouth, and other things of that nature.
All right. Well, let's jump right into it because it's been actually 2 weeks since our last episode. I was speaking at the Silver and Gold Summit out in San Francisco, so we skipped a week from doing the pilot. And essentially, a lot of stuff happened this last 2 weeks. And obviously, we always come in and want to say what were the most important things that we saw, and how can we not talk about what happened in the stock market, right?
Right. So that's your number one thing of what we were going to talk about?
Oh, absolutely. And obviously the question on people's minds has to be, is this the beginning of a new bear market?
And what do you think?
Well, you know what? Back in my 2018 market forecast, I'm one of those crazy people that actually attempts to do one every year. And nonetheless, I did my 2018 market forecast back in December. And one of my key themes was that the entire year was going to be a large topping formation of the bull market, and that we were going to transition into a bear market on the other side. And so this fits my narrative. Even when I was talking about the summer rally and expecting it throughout the summer, I was always going with the idea that the rally was going to end as a retest of the previous high, sort of like a development and top. But what it really will be the nails in the coffin in my mind is going to be whether or not the market shows a lot of fizzle, like in terms of a follow through on any short-term rallies. Because if that pattern develops where this buy on dip mentality dies and rather everyone's selling into strength, that's actually going to be the real price action tell that is going to make me officially feel that shift has occurred. What's your take on it?
Well, as you remember from the last podcast, I was a little more bearish than a lot of people.
Okay, I'm going to give you credit. First of all, I forgot to do that. Listen, everyone remembers the last pilot podcast. First of all, I'm a bear, and here I was like, listen, I think we're going to get a bounce, and things are going to turn around on the short term. And you came into the episode, and you're like, no, I'm bearish, which I was actually quite surprised by. But hey, kudos to you. You've gotten a lot of things wrong, but this one you got right, right?
And I can always count on you to point out the ones that I get wrong, Patrick.
Absolutely.
So, and I viewed it as the Chinese situation with Trump, and I looked at the way the geopolitics and the whole trade tensions were setting up, and I was fairly early on the story of saying that this was going to affect the stock market, and what it's now become the narrative that's why we've gone down. But if you remember when I first kind of proposed that theory, people thought I had a tinfoil hat on and that it had nothing to do with the Chinese situation. And I looked at it and I thought to myself that we have a situation where Trump was kind of had he was on a path to take a hard line, and I didn't see him changing anytime soon. And then I saw the Chinese, and I didn't think that they were going to cry uncle and all of a sudden to give in either. So I saw two superpowers that were on a collision course, and I thought that would affect the risk assets, which is what's happened.
I was almost sure you're going to say Italy. And we'll get to that.
Yeah.
A little bit.
So now I'm not probably as bearish as some, because I think that we're going to have, and we saw that this morning or today, Trump all of a sudden is making some kind of cooing noises with the Chinese, and I think that he's realized that trade wars are not good and easy to win, and he wants the stock market going up. Now, that doesn't mean I'm saying that he's going to go and actually make a deal, but I do believe that over the short run, he's going to be making all sorts of noises saying that the deal is coming, and that will help the stock market.
All right. Well, I mean, you can make that argument here. I'm going to share a chart of the S&P 500 here, and really, obviously, we had this very distinct sell-off. I was talking about the 2600 to 2650 level with my members throughout the last couple of weeks for the downside, and we got a pretty healthy bounce. To me, I'm far more technical than looking for stories to justify why things have happened. This market correction was very meaningful. Whenever you see something like this where literally the market wipes out, like it took us 6 months plus to have this big rally, and we see right on the other side a drop that basically wipes out the entire previous advance. And the more serial underperformer was actually not the S&P but the Russell. Like, look at the Russell completely slam to the downside.
It's an ugly looking chart.
It's a very ugly looking chart. Nonetheless, whether we use the Russell or the S&P as the kind of benchmark, we are oversold. And as a technician, whenever there's oversold conditions, there's always mean reverting retracements, right? And with some technicians like myself will measure with Fibonacci's and other types of tools to do that. But as far as I'm concerned, there should be a bounce, and the bounce is actually so important to tell, because if I was to, let's say, reverse back in history, I want to go back to, if you don't mind, actually let's go to S&P, and let's go. We'll switch it to a weekly chart, and I want to rewind all the way back to 2007, and I want to kind of illustrate. Okay, so here was Bear Stearns, right? So this drop right in here was Bear Stearns, right? This was when the two the subprime credit hedge funds blew up, right? And then there was the big rebound in the summer rally that made even a higher high, very similar to the way the S&P did,
right?
And then it drops about 160 points, 10%, which is what 10% happened here. Even though this was more like a 300-point drop on a percentage basis, we're actually talking about the same drop.
Right. Understood.
Next 4 weeks, the market goes and retraces half of the loss.
Right.
Right. And so we're back half, but yet that was just the beginning, right, of what ended up being a nasty bear market. And so the one thing, I'm not trying to predict and say that this is exactly the way it's going to play out, but to me, it's all about what the market does in the next 4 or 5 weeks that will give us the clues as to whether truly there's a bear market afoot.
Well, I think that's some great points. And actually, could you go back to our slides and pull up my slide? Like, you love the squiggles and stuff, and I love the stats. And one of my favorite guys is this.
You want that tweet?
The tweet from this fellow that I love is Odd Stats, and he's a very interesting fellow. He basically keeps all sorts of different statistics, and he kind of shares them with it. And he's a must follow on Twitter. But he keeps what he's showing us here is it's a spreadsheet where every morning he mechanically sells 3 S&P puts that are 2 standard deviations out on the Friday to the closest to 30 days expiration. And then he shows the running profit. Now, what he's basically doing there is put selling and showing how if you did this strategy day in and day out from 2015 when he started his spreadsheet, you did not have a single drawdown. Except if you could click on the chart, you can see that we actually had the first time. And that is why I think that this...
So even in February, he didn't get drawn.
Yeah. Now, a lot of times in February, don't forget, it was actually more of a vol event than it was an actual stock
No,
market.
the price. No. The price dropped on the S&P.
But also, well, yeah, but don't forget, he's holding it to expiration as well. So this isn't a mark to market.
Okay, so in other words, if the S&P bounces here and those puts expire,
No, but I think that this happened to him because he has different ones, and he's saying that
this was October 19th
right.
expiration.
And so I think that what's happened over the last little while, and if we think back to the last week, Tuesday was it Tuesday that was really ugly when all of a sudden vol just went bid and everything went for sale?
No, it was Monday that was the big here.
Okay.
Let me show you right here. So it was Monday that was the dump down to 2,600,
okay,
right?
So
and then we basically Sunday to Monday, and then we
right.
basically reversed and been rallying since, right?
But if you go look at the statistics of what happened to that breakout in terms of volatility and what we saw on the odd stats.
You want to?
No, this is good. This is a good chart. And in Charlie McGilligan, which is your favorite guy in Muir, he talked about the prime brokerage data showed that Tuesday was the largest day of equities long short gross down in 3+ years. So what does that mean? That means that hedge funds who are long stocks, but they're also short stocks, when the volatility rises, they just instantly lower all their positions. And that is what we saw, and that is one of the reasons that we saw that violent move was that hedge funds were just paring down risk, and they just get it off the sheets. And there was a little bit of panic in the air that day for sure. And so I think it's really interesting, and I think that it's opened up the possibility of a bounce, and that is why we've seen the last few days a rally. But I think that now we're kind of at a stage where what is the next move? Are they going to put risk back on, and are we going to head back up? Or is it going to be a situation like you're talking about, not predicting, but talking about the possibility that the thing rolls over from here? But more important than that is, and what I think one of the things we should talk about is the leadership. What's happening in the stock market?
Yes.
And why don't you go? Because you have a theory, and I'm just going to agree with you.
I don't know about a theory. What it is that it's more of an observation, right? Because what we have witnessed, we talked about in the last episode actually, which was this whole idea. We had a flattening curve for basically 2 years. During that, like you were saying, the long duration asset is the best performer, and the single best performing long duration asset is growth, right? And so everyone goes FANG, everyone goes into the Facebooks, Amazons, Googles, and the whole spectrum. And what we saw was a massive kibosh of this entire space. And I mean, think about it. Amazon wiped out, was it near 25% of its value off the highs. Now, so what was interesting about this is, okay, remember when the big headlines were that Apple and Amazon were both trillion-dollar companies?
Right.
Right.
Whenever you see headlines like that, you should be starting to think about the
right.
other way.
And what everyone was saying, well, when is $2 trillion?
Right.
They're asking like when is it double from here? Yeah. Right. In terms of and it reminds me of PetroChina. Remember PetroChina?
That's right.
First $1 trillion market cap company.
That's right.
Was that 2007? It was in that 2007 window. It was like in that a decade ago.
Right.
Like I don't know the specific date, but back then it was the first $1 trillion company. And what did the thing lose? Like 60-70% of its value, and it's never recovered.
No, you're absolutely right. When the media starts talking about those kind of big round numbers, you have to step back and ask yourself whether you want to be involved.
Yeah,
because that the mistakes are just they're just coming in. It reminds me actually of Bitcoin. Like the Bitcoin at $20,000,
going 100,000. I mean, I knew that was the top the moment we heard that shit. Right? Like, I mean, I was on Macro Voices with Eric, and we were basically doing that. We're like, you know what? Eric was, I don't know whether it's going to go to 100,000. Well, I didn't mean to say that in a way that's like thing, but I mean, he was just very like open-ended that we don't know how high it can go.
Right.
But to me, I didn't know the price level which Bitcoin was going to think, but I knew that in a window of a couple weeks that this thing was going to blow off. Like when you have that kind of a parabolic rise, the gravity grabs it by the heels and drags it back down at some point, and it doesn't take 3 months
Right.
for it to happen.
So let's go back to the stock market.
Yeah.
So there's no doubt that the high fine growth stocks have been they were taken out to the woodshed and shot, right? Like they're ugly looking charts and they're broken. Whether
The generals are dead on the field.
So now, does that mean that the stock was that the final man standing, and does the stock market slump from there, or can somebody else step in and actually cause
that? Was what I wanted to talk to you about, because in my mind, these tech companies are likely done being leadership at this stage in the market. And at some point in the future, there's another cycle emerges and they'll regain their thing. Like, we're talking about the current present moment.
So are you saying that FANG has hit its top and will not?
Yes.
Okay. So you're saying that FANG it's over.
I feel that the damage done, and particularly with Apple's miss, we'll talk about it. It really, in my mind, Apple and Microsoft were the two last generals in the field that could have, if they had the right beats and the right momentum and pushed to new highs, that these two generals could still lead another run to the upside. And so what we're seeing is general after general is being sniped off in the field, left there to die.
Right.
And the troops are going to scatter. And the only way that the troops don't scatter is if a new leader or general steps up to bat and rallies the troops and brings them in together. Now, there's theories. I was out at the Silver and Gold Summit, and I was talking with Brent Johnson, and one of the things we kind of went back and forth, and he agreed in the thing that maybe it's the financials. Maybe the financials are, but we were dead wrong a couple of weeks ago, if not a month ago, when we were talking J.P. Morgan and the turn.
You're absolutely correct. But no, he's right. The U.S. financials are dirt cheap. I'm going to throw something out here. I think the home builders.
Oh, Jesus.
Yeah, I know.
Jesus. You know what? No, Kev.
Okay, I know we have our... Listen.
And why don't we buy Deutsche Bank too?
Okay.
Here we go. You know what? No. You turned around and you wrote that blog. What did I text you within an hour of you publishing your blog to go
sold
long?
to you?
Exactly, sold to you.
Okay, so maybe I was early and I'm missing a few fingers, but I actually was laughing. Did you see Deutsche Bank rallied off the bottom hard?
Oh, Jesus. Hold on a second.
And do you know it rallied off the bottom hard because there's some crazy hedge fund that's bought 4% or something.
Well, and to you, this is a change of trend. Like this is what you're resting your hat on. Like this is what you're. Oh, okay. It's bounced off the low, and therefore it's all over. This reminds me of you trying to call the bottom on. No, actually, not you. Me trying to call the bottom on General Electric.
Yeah.
Every little rally's the bottom.
You know
right?
what? Funny you speak about General Electric, and why don't we just talk briefly about that? Because I noticed that it's had its trouble. And I probably have. I'm also missing a finger or two from here with some positions that I have. I gave up when they had a kitchen sink quarter, where they were trying to throw it all in. Unfortunately,
and their entire dividend.
Yeah, well, I think the market could have handled all that. What I think really was the problem was that they had accounting irregularities that they said there was an ongoing SEC investigation. Yeah. And I noticed that some big guys were selling it, and that thing was for sale, and it looks like death, no doubt about it. But I noticed this afternoon that the final downgrade of their debt happened. And
what are they rated now?
I don't know, but it does this is the.
How is it final? Final would mean
not
that
final.
They're the lowest grade.
Yeah,
possible.
But it's just that this is the thing the market's been worried about, and it's happened, and I'm not. It still looks like death, and that's a terrible looking chart. But I remember
if it ticks up to 10, like a Deutsche Bank on that chart, suddenly you're going to be bullish.
Yeah, no. So I saw that. I remember one of the deep value guys, that Hempton guy from Australia, that one famous hedge fund manager that I really like. He's been bullish on it for a little while too, because he's a true value guy, and I remember him saying, I want to own it now, but it's going to be on the actual downgrade that you should own it. Mm-hmm. And I thought to myself, you know what? He's absolutely right. And I wonder if this is the bottom.
What I've learned the hard way in the markets is that you don't want to just buy price level alone. You have to also identify when the sentiment is shifting enough to actually begin an advance. And I'll give you an example. You could have called the bottom on gold in 2015 It's been already 3 years since the low in gold and the gold miners for most gold stocks. But it doesn't make it feel any better being stuck in purgatory for the last 3 years. So, yeah, maybe this price level. But now, GE is no longer paying a dividend. So you're not being paid any positive hold and carry. And at the same time, it may take years for them to establish a base from which they're going to rally.
Patrick, I couldn't agree with you more. Like that, you're absolutely correct. Having said that,
we should try to disagree.
Yeah,
sometimes,
no. Well, we disagree about a lot of things, but this isn't one of them. That it's very difficult. So I'm sitting around trying to catch this knife. To be in their interest of full disclosure, I'm selling puts. Like I'm trying to figure out something where I can actually earn like positive carry on it. And funny you talk about the golds. I think that one of the best ways to play it, being long gold stocks, is the short dust, which is the 2 or 3 times inverse negative kind of ETF.
And just you take advantage of the mispricing.
Well, it's not a mispricing, but there's a for our listeners that have ever played on 2 or 3 time levered kind of ETF products, you realize that you have to be really right because the volatility as it chops around actually chews you up. And it's almost a negative gamma position. So if you can go and be short that thing, and listen, that's a scary position. It's not for everybody.
Actually, why don't we do this? Let's save this for a future episode when we get Tales from the Trading Desk, because I actually have a great couple stories about these ETFs and inverse ones and leveraged ones. This is a great topic, and actually we need to talk about this in greater detail.
Okay, so I have a question for you. So I'm gonna put you on the spot.
Yes.
Is there going to be a new general that leads, and if so, what is it?
I don't think so. I'm actually bearish the stock market. But with that said, I want to put one disclosure here. I feel that the real sell-off, I think that even though the market here may retest the lows, reestablish itself, I don't believe we're going too much lower than 2550, 2600, even if there was another sell-off. With that said, we're going to have some consolidation. It doesn't have to be a full 61% retrace like everyone's thinking, but maybe it is. But I do not believe the stock market makes higher highs into the end of the year, and I believe that this will all roll over into next year with some very heavy selling, and I don't think a leadership will emerge. I don't think so.
Well, this is what I think. I think the value is going to get bid.
Okay.
So value stocks are gonna rise up here.
And Dunlap's gonna look like a hero.
And I think that we're gonna have a situation where things that have been down and out that people have hated, like home builders, that you laugh at me for. I think that if the Fed can just get out of their own way and stop raising rates, the home builders are gonna fly. I think that we're going to have the financials.
You know what? I'm going to rake you over the coals for this home builder call, dude.
You know what? I love how bearish you are on the home builders.
I'm not bearish. I just don't. You just said that you think they are going to be the leadership.
Not the leader. I don't think. I think that they're going to. Well, so
is that what? Am I?
No. So I do think that if you think about Trump, stop and think about Trump for a second. He is a real estate guy. And I think there's a lot of things in the U.S. that have actually lined up. So the millennials so we're Canadian. So all of our millennial friends or acquaintances and stuff, they all own houses. In the States, they don't own houses. They've been waiting and waiting and waiting. And although everyone will say, "Oh, they have a bubble," they have a bubble in the 1% markets. You go to Kentucky, you go to the Midwest, you go look at the housing. There is no bubble in the States.
I'm gonna bust your entire argument with one thing, and that's called Powell. Okay, I'm sorry, but the mortgage rates are rising. It is the liquidity is being drained out of the system. This is not the stage of the cycle where everyone is going to rush out and buy houses.
So yes, I understand your argument, and that was what I said. If Powell can just pause, and I think he will. So I've changed lately. I think that they're going to have more. I think the whole
even pausing does not act as a stimulus. For if I'm an average American and I turn around and I say, they stopped raising interest rates. Now is my opportunity right at the top. Lock in a mortgage right at 4% mortgage when I could have got it at 2% a year ago.
But it's still, if you look at it versus the cost of renting, and it'll still be cheaper. And I disagree with you. There's the affordability in the States.
All right.
And I just see the millennials in the States, they put off raising families, and they put off a lot of things because things have been so bad.
You are right about the demographic.
Yeah.
You are right about the demographic. You're wrong on the timing. Look, you know what? If we got a 5 to 10 year time horizon, you're going to be dead right. I'm not going to say that you're wrong about your theory, but listen, this is 2018 going into 2019. We have a business cycle about to turn, and you are betting that right here into a turn of a business cycle, that somehow everyone is going to go in a mad rush and start buying real estate.
So I think that you're going to be surprised. And let's pull up the XHB, and let's make a gentleman's bet.
The
Oh,
XHB.
there we go. There we go. Okay, so
No, okay. You said leadership. So what is it in your mind, a leadership on this chart? Going back to its previous highs? It should be a new bull market, right?
yeah, no, I think
I'm going to put this on a weekly chart. So you're saying here that this thing is about to rip to the upside like this, and this is the leadership of this.
yeah. I think it's going to be the best, one of the best.
All I'm going to say is no comment. I'm going to.
Okay, how about this?
I'm going to rake you over the coals for this
We're
one.
on tape. How about this? We'll look at the performance. You pick your favorite sector then.
Okay, okay. There's no doubt that this has room to bounce, right? And
No,
look,
but just so,
what I don't look. If we're only going to talk about the fact that look, when a sector
then
like
second. How about this? It beats the S&P. It beats the S&P by it's in the top 3 of the groups.
All right.
There we go.
All right.
We're done.
Deal.
Okay.
All right. Sounds good. All right. I want to now move on. And we're going to move on to junk bonds. Now, for our listeners, some of you may not understand the bond markets at all, but the junk bond, or when we reference the junk bond...
One second, you're selling all of our listeners short, you realize, when you say stuff like that.
I am talking about that 1% that don't. We're trying to bring everyone to level playing field.
Yeah.
Bottom line, we're talking about debt, but debt that is of a lower grade than triple B. So we're talking about companies that have to pay a substantial premium in the debt markets in order to raise capital because they have some sort of problems with their companies, the balance sheets, their growth prospects, and they have to pay a substantial higher premium borrowing money. And so this often is the sector that runs into trouble if there is a recession or something like that. So, Kev, you're the one who put these slides together. Take us through a journey of what's on your mind.
Okay, so this is the HYG, which is the High Yield Bond Index ETF. And so it's filled with all sorts of bonds of that nature. So we need to remember that there's 2 things affecting the price of a high yield bond. One of them is interest rates, and then one of them is the amount that they have to pay higher than the government to borrow that money.
Yeah, the credit spread.
That's correct, the credit spread. But what we're looking at here is a combination of both. It's just the absolute return. So you can see I've highlighted and I've put in this white gray box. I put in the kind of return of October. And I guess we went into the beginning of October at 86.5, and that thing closed. What is that number?
84.5, 84.
Yeah, and I know that doesn't sound like a lot for our kind of our swashbuckling kind of equity traders, but in the bond world, that is not good. That is a bad kind of return. The bond traders and the bond managers will be having glum faces.
Now, I like the idea of putting this in a longer term chart, because what I want to point out is if we go back to 2014 and 15, there was a massive crash in the high yield bond market because there was a very large amount of energy companies that finance into this space. And when oil crashes from $100+ down to $26, the amount of debt restructuring and defaults and things like that were incredibly high. This time, though, we kind of bounced off of that really ugly period, and this looks like a chart sentenced to death.
Right.
Like it's rolling right over. What do you see in this chart?
So first of all, you're absolutely correct about the 2015 being very specific to energy, and that what was interesting about that period was although the energy stocks or the energy bonds were getting decimated, the regular bonds or the non-energy bonds were fine. They were bid. And so if you were a bond manager that actually managed to avoid energy bonds, you were doing just fine. So even though the chart looked terrible,
as long as you didn't own Toys R Us.
There was the occasional other name. But now we don't have any of that. So it's just the whole thing is rolling over. But when you look at the chart on a kind of a longer term scale, you realize that maybe this has just started. Maybe this isn't as 100%. Bad as even though the bond kind of managers are having a grumpy month. Maybe this is the start of something worse. And this goes back to your kind of prediction or kind of call about the stock market maybe going lower. Maybe this will be what leads it. So let's go to the next chart. Now, this next chart is the spread of the rate of those high yield index over Treasury. So if Treasuries are yielding 2.5, this thing, if it's at 3%, which it was at the beginning of October, that means that the average that index would be yielding 6, and if one's 3, then the other one's going to be 6. You'll see that what's happened to the spread during that whole month is expanded. It kind of blew out to wides in terms of...
In other words, Treasury bonds stayed stable, but then junk and actually investment grade also went down.
Yeah, Treasury bonds, if you remember...
started down.
They started going down, but then they got a bid later. They ended up pretty well flat, but... high yield bonds ended up much lower because of
investment grade bonds, by the way.
That's correct. Now... you look at this chart and you go, oh my goodness, this thing's moved from 3 to 3 3/4, and that seems like a huge deal. Let's move on to the next one. You'll see that it's really, on the grand scheme of things, it's nothing. It's nothing. So although I'm watching this space, I am concerned that the amount of pain that this caused, because this was one of the things that caused the stock market to sell off, is actually quite disproportionate versus the move in the actual bond market.
You know, the one thing that this is a conversation I had with Eric on Macro Voices, and we were talking about this very spread because we had Jeffrey Sherman from Double Line Funds on, because Jeffrey Gunlack at Double Line has put on a number of these charts that basically say that when the credit spread start to widen, you can literally start a countdown clock to a recession.
Right.
And to me, that line is 4%. You drew this red line about 375, but I drew mine a little bit higher, around 4%. And to me, it's really relevant if we see a continued widening of the spread, because up till now, even though junk bonds have been selling off for over a year and a half, they have really just been lockstep with Treasury, which is, Treasury bonds would rise by half a point, and junk bonds would raise a half a point. The spread stays nice and range bound within 3 to 4. But what point does that all start to steepen? And what is the one cause, Kev? I'm going to tell you. What is the one cause of a steepener in this credit spread it's driven by?
What would cause the spread to blow out to wides? Like, why would that expand that spread?
Right.
And it would be the economy rolling over.
Well, and particularly defaults.
Well, and defaults occur when the economy rolls over.
Right.
But can I push back a little bit about go back to the chart? Gunlack, and far be it from me to make say anything about our good friend.
Oh yeah, because you didn't say anything in the last episode.
Our good friend from Buffalo that with his a very kind of eclectic videotape collection. Just Google Jeffrey Gunlack deal breaker, and you'll figure that out. But what would he say to the fact that we blew out to wides in 16 and yet we didn't have a recession?
Yes. You can. There was a driver for that, but I'll give you an example. We had negative GDP prints in Canada when that blew out because we had such a huge component of our economy linked in Alberta to energy and things like that. So the U.S. economy, it was very specific to a sector, and it wasn't broader that way. So yeah, you can make that argument.
No, and you're absolutely. And the other thing that people talk about there are some guys, some pundits out there who believe that we did have a mini recession in 16, and
I think so.
And it was there. And if that is the case, then it could throw a lot of our, our timing off. If we accept for a second that 16 was a mini recession, then all of a sudden when you talk about 18, you might think maybe we have more longer to run, and maybe it's not as long in the tooth as we think. Now I know
I just puked in my mouth a little bit. Sorry. Go on.
It has nothing to do with our sponsors. Thank you to
the beer
Thornbury
tastes
Village
fine.
Beer Ladder Run Amber Lager.
Let me just take a sip to rinse that taste out of my mouth. Listen, you and Tom Lee can go into your little camp of the bull market will last another decade and there's no recession. Yeah, and buy home builders, dude. Oh, listen,
Okay.
I think the next chart tells it all.
Okay.
So what I was so you called me out on that. Yeah, there was a steepener in the past, and it didn't lead to a recession.
It's not a steepener. So just be wary of
it's not a steepener.
It's a widening of spreads, right?
Sorry.
A steepener has to do with the curve and
my bad.
Yeah,
my bad. I just used the wrong word. But what I wanted though, I think this chart tells a better story. In my mind, that spread has a lot to do with the rate of defaults on that debt. So now we had central banks flood the system with credit, have record level low interest rates. Zombie companies can stay afloat because they can access capital and pay a lot less for it. There was, especially in Europe, there was some junk bonds that were being financed at 1%. Like I know Jim Grant was kind of speaking about that in the past. So there's been a massive divergence. So you can see on this chart what we're showing. So let's talk about what we're seeing first of all. So yellow is the debt as a percentage of the U.S. GDP. Now, specifically corporate debt. So what they're doing is saying how much have corporations borrowed and what is that amount of total aggregate debt on a percentage basis to what the GDP is. And
David actually specifically non-financial corporations.
Non-financial.
Banks can mess it up with
absolutely. And so non-financial.
So it's real companies.
And exactly. And so David Rosenberg, when he has talked about this numerous times, right, including when he was on our show at Macro Voices, and what you see here is that also the high yield default. So this is where I was saying was that look, if there's a growth in the rate of defaults, then in the junk bond investors must be compensated for the fact that a certain percentage of this debt is going to have to be restructured. It's going to have to be go full default, whatever is going to happen, and that loss has to be priced into the yield. And so as the defaults rise, so will the thing. Now, it was interesting. One guest that we were talking about bringing on to Macro Voices, it was Edward Altman. That's it. And I was watching a presentation from Edward Altman, and what was interesting observation he made was that a lot of default rate spikes happen before the recession, not because of the recession. I thought that was mind-blowing when he showed that, and I'm so looking forward to in December when he comes on to the show, because to me that's not logical. To me, I'm thinking there's got to be a recession, and the recession causes defaults to rise and go. But
the recession is caused by the default.
But what if the default is caused by higher interest rates, which is happening years before the recession?
You're right, and when you look at this. When you look at this chart, it's hard to not argue that the rate upon which these high yield bonds have been issued is not astronomical, which will eventually lead to more defaults, because as more easy money is put out there, eventually covenants are light. And I saw somebody saying the other day, the only covenant you have, I think it was I can't remember, the Lasry guy from I can't remember what big hedge fund he runs, but he talked about the only covenant that's left is the covenant to ask for your money back, meaning that they have no ability to go and say that you've gone and you've fallen below this debt to GDP or something. So I look at this and I agree that it is scary. But the central banks keep throwing money at it.
Do they?
Well,
okay, come on. They're all tightening now. They're all reducing their balance sheet, so they're not throwing money at this anymore.
Well, I think the real question, and I think we'll have to leave this for another day, but the real question is, when the economy rolls over a little bit, will they still keep tightening? How committed
I don't
are
think
they?
they will. They won't. They won't.
Well, and
They
if,
have
and if that's the case,
one of my big narratives is, and we'll talk about it in future episodes, is that we're no longer in a free trading economy. We're in a managed economy, and central banks will start easing the moment that they see that the whole engine is seized.
well, if you believe that, then you don't believe that green.
No, it has to get worse first. They're not going to bail out something that hasn't broken first.
And I guess that's the real question for our listeners.
All right, Kev, moving on. This week in trading history. You know what? I'm a little bit younger than you. And so I know you were there back in 1929. What was it like during the Black Tuesday that occurred back in the last week of October in 1929?
The Black Tuesday. How much older do you think I am?
Well, I don't know. I can't tell with your Ben Bernanke haircut.
Yeah, no, I actually unfortunately missed the Black Tuesday. I was still, although I was around, I was still just learning how to trade, so I missed it. But it was it was this week in history, and we made this same. The last time we had our episode, we talked about the 1987 crash, and I worry that we're now talking too much every time about a crash. But I guess that's what happens when you
talk in October.
That's correct. So it was quite a day, and although I was still running around delivering newspapers, I wasn't trading very much. It was still I saw the headlines as I delivered them, and it was shocking to me the pain that was out there.
50% wipeout in 3 months.
Yeah, and just
3 months.
So what
that was? In 1987 was like a 20% down day in one day, and it was altogether a bit more, like closer. Was it closer to 30% altogether?
From the high to low, maybe, but it bounced pretty quick. Too,
it bounced pretty quick. But this was a 50% wipeout in 3 months.
And what I like best are all those pictures of the cars, the old guys with their cars saying must sell because of margin and stuff like that. It's just, it makes me laugh, and it reminds me of my youth.
When we have a bigger air pocket of time, like during the holidays, what we should do is go back and reflect. There's great stories from books like Lords of Finance of the 1929 period, and a lot of the monetary policy errors or the drivers of what drove this. And I think it would make great content for a future episode.
Speaking of monetary policy errors, Federal Reserve that was too tight. Does that sound like anybody?
Yeah, no, it does. Anyway, but nonetheless, that this was this time in history. Moving on, we're talking about the WTF video of the week. And it was amazing, Kev. Like, we laughed so hard when we both came up with the exact same clip. I said, "Hey, check this one out. At this minute mark, we got to talk about this." And what's funny is that you prepared it, didn't look at my email, and it was the same clip. Just like out of all the videos out there, how did we come up with the exact same
serendipity? And it was just begging to be done. So without further ado, let's go to the WTF video of the week.
I do want to just get your reflection on this market move today. It's been a while since we've seen a down 2% in the S&P. You have any thoughts about why we're having this down move, or what may be causing it?
Clearly this is not a monocausal event, David, but I think that, look, on this day back in 1929 was the beginning of the stock market crash, and October 19th, 1987. It seems to be bad days in October seem to happen regularly. But I think when you look at today, one of your other guests earlier this morning pointed to the fact that the ruling coalition in Italy is essentially a Donald Trump and a Bernie Sanders deciding to rule together. So they're going to lower taxes and raise spending, and clearly that's not going to work with the European Union. I think that's having a lot to do with global markets in the last several months, and a lot more than people think it has.
5, 4, 3, 2, 1, go. You're only supposed to blow the bloody doors off.
All right, Kev. So this was a funny video. We both had something to say about it. But you first. What made it that comment stand out for you?
Well, just before we start, I should tell our younger millennial listeners and those that weren't around in 1929 that video is actually the Italian Job, and not the Charlize Theron version and the Mark Wahlberg version, but the original version. So it's an old movie, but I thought it was particularly fitting given the fact that Kyle Bass, who is a legendary hedge fund manager, was so quick to blame the entire stock market sell-off to the problems in Italy. And I shook my head when I heard him tell me this, that he thought this was the main driver. And I couldn't disagree with Kyle more, but that's what makes a market. What do you think?
Well, okay, in the same way. First of all, in all fairness, he said one of the things that people are underestimating its influence. So he was saying that there were other things. So let's not just put words in his mouth. But he did seem to feel it was important to mention that he thought it was Italy that was an important topic. And to me, I'm going through all the things. Okay, so everyone's offside. The yield curve starts steepening. Two people are holding way too much gross. CTAs are 100% net long at the worst possible moment, driving a massive liquidity run on the marketplace. There's catalyst after catalyst for all the things, and we're going to go and blame it on the Italian government. That they screwed everything up. The goddamn Italian government.
And it's, what are they doing? I kind of laugh. They're asking for a 2.4% of GDP deficit that they want to run. Oh, Lord, forgive us, that we're running to run a 2.4% deficit. Do you know what the U.S. is running right now? What is it? It's north of 4, and I think it's approaching 5. So the idea that this is somehow some sort of crazy budget, and I know all my hard money, critics are going to write me in and tell me how the Italian situation is, unsustainable in the long run and stuff. But, wake up. All of this is unsustainable in the long run. There's so much debt to GDP out everywhere. And what the Trump has shown us is the fact that spending is the only way out of this.
Austerity does not work.
Yeah, and I know there's going to be people are going to tell me fixing the problem of too much debt with more debt doesn't work, and all this yada yada yada. But I go back to Japan and I think about them trying to cut their way out of it kind of 20 years ago. And every single time they tried to do it, it just made the debt to GDP worse. And my analogy that I like to give is that when you're on a really steep downhill ski hill, what the tendency is for people to lean back because they're scared. And what you actually need to do is lean forward. And I still think that all these countries with their problems with growth, that what they need to do is spend, and they need to spend it smartly. Don't get me wrong. Don't go give money just for nothing, and don't do a Paul Krugman, but spend it on infrastructure, spend it on smart stuff, invest, because there is no private demand for funds. They have to do that.
That I'll leave it with one comment. We had Daniel Akale on the show just a week ago on Macro Voices, and one thing he said, the ECB is the worst central bank in the world, and the entire the entire European situation is so foobar because these individual countries have basically forfeited their right to control their own monetary policy, and they're all trying to do it as a collective. It's going to end badly. I don't know. I don't want to be a total Euro doomsdayer, but I think Italy is just a symptom of a problem of the fact that the entire Euro system needs to be completely restructured. This idea of the fact that you can have national sovereignty, but yet you have financial unity is not going to work. You either have to go all the way and make Eurozone one entire country that functions together, or it's going to the system is going to break. This is my opinion, but we'll see.
Well, now it's that time for Tales from the Trading Desk. What do you got planned for us today?
Well, listen, I wanted to go and talk Nortel, right? And this is just a story that, in one way or another, I feel it has made such a big impact on everything that I've looked at in the last 20 years. I came out of university, started working at CIBC early on, right out of school. And I'm sitting on the trading desks as just a kid right out of school. And it was in that 99, 2000. I don't know the exact specific date. It was sometime in 2000, and we're sitting there, and one client owned their entire investment account at Nortel, and they phoned me up the day of their earnings at 3:30, a half an hour before the market closed, and Nortel's about to announce its earnings right after the bell. And he asks me a simple question. And remember, I'm just a kid. I don't have the wisdom that 20 years of mistakes have.
Patrick, you're implying you have all sorts of wisdom now.
Well, yeah, I.
You're not as old as me, Patrick.
Well, you're the one that writes on your blog 25 years of mistakes.
That's
right?
correct. Yeah.
But yet you have 30 years of trading experience. I'd love to find out what happened to those 5 years that you're gapping there. Me, I have just a mere 20 years of trading experience, and but back then I had none, right? Like I was just learning. I was a few years out of the gate, and to me the world was my oyster, and I just had to, and I thought it was easy to make money in the markets. And so this guy calls me up, and I don't mean to pick on him. It's not the point of it. He calls me up and asks me how many shares of Nortel can he buy on margin. So let's
alarm
clarify.
bell should be ringing right there.
Right, absolutely. So just a little history. By the way, this chart is reflecting it's like 10-for-1 reverse split and other stuff like that. At the time, at its peak, it was like $120 or something like that. I don't remember what the exact peak was. And then it dropped from like 120 down to 90.
It was more talked about in Canada than Bitcoin, marijuana stocks, all combined. It was everyone. It was obsessive. It was just... It was
okay. Back then,
yeah.
Nortel and BCE combined made up 1/3 of the capitalization of the entire Canadian stock market. And because RSPs and things like that back then, which those of our American listeners that are listening, those are the equivalent of 401ks. Right. Your retirement accounts, basically, you had to hold the majority in Canadian holdings back then. And so with resource stocks being completely in bear markets, if you're a Canadian, what stocks were there to own?
Yeah.
Well,
and
Nortel,
not only that,
what was it, like JD?
The real problem, though, was that if you didn't own Nortel and Bell,
you had no performance.
Right, because it was flying and it was running like it stole something. So if you sat there and were prudent and underweighted it, you for that whole period from 99 to 2001, you actually lost.
And you watched your neighbors driving Porsches and all that other stuff because they all made so much money off of Nortel.
And it was crazy. I'll let you finish your story, and then I have some good institutional stories. But you finish your story about this guy and what happened to him.
He turns. I just did the math, and I said you could buy 1,300 more shares. And so he goes out and goes from like 700 shares to 1,300 shares. Sorry, to 2,000 shares. Bought a 1,300 additional, and so he's got like 65,000 in equity back then in his trading account. And that after the bell, Nortel, like literally 30 plus minutes after I did this trade for this guy, gaps down to $60. The next morning, his account was worth minus $5,000. And then what did he do? He met the margin call by going and get the bank and getting a line of credit. Yeah. And then he lost that too. Now, I don't mean to pick on this person, no names, no nothing. It changed my life when I did this trade because I felt partially responsible, even though I was just executing the trade he told me. But my heart... it changed the entire way. Like those of my members that know me know that I'm so careful on risk management, buying protection, having some hedges in place. A lot of that started with that very story. Yeah. And so what is your story?
Well, so Nortel was on the institutional desk. I worked at RBC Dominion Securities and was a big stock that we traded a lot of, but it's actually not my firm, but there was another firm that had a little bit of a trader that had a wild reputation. And he took risks, and these were the days when the bank didn't monitor our risk as much. And we would toss around big pieces of stocks as we traded with pension funds and other institutions. And he found himself the same way, long Nortel, going into that earnings report. And what happened was, I believe that he got blocked that he couldn't sell. And so he was stuck with the position, and it was a big number. And the stock gapped down $20-$30 or whatever the number was. And instead of selling and taking his loss and telling his bosses, he literally put the trade in the drawer and didn't tell anyone. And then proceeded to make it worse and worse and worse. The best part of this story, though, is that one of my good friends went to work for that firm later as their head trader, and he would go and like open the drawers and go, "Hey guys, look what I found." And he thought the joke was hilarious. Literally, like nobody else, those poor other people had all lost their bonuses and not done very well. But he kept doing this, pulling out trades that he would kind of make up and just kind of have a ticket made out and stuff. Because when I believe when this one trader went, they said something to the effect that they said, "How did you hide the trade?" And he says, "I just put it in my drawer." And so that was the kind of the joke was.
Well, you can't get away with that when the electronic day today.
Oh, you're absolutely.
And with the new compliance risk management teams, it's unbelievable today.
You can't.
But back then, that was like the Wild West, right?
It really was, and it was pretty funny.
Oh, absolutely. Okay, let's move on to the final segment. Let's move on to the top 5 things to watch for next week. So, Kev, why don't you start us off? What is the number 5?
Well, the real question is, Apple had a terrible day the other day on the earnings announcement. Tim Cook said they're no longer going to break out Apple iPads and all the different sections, and that's all a sign of something going wrong when a company no longer wants to break out the different sales. And it left a big, huge gap. You tell me about the squiggles, but the real question is that gap going to be filled?
That's actually a really big question, right? Like, so this is the gap in the square. Obviously, will it continue to sell off like Facebook and just keep bleeding out? Or are we going to see this gap fill? That's definitely a thing to watch next week.
So what do you think about for number 4?
I want to know whether or not the gold breakout is for real. Now, it was really interesting is that gold, certainly, we'll put up a chart right in here, but gold has made a pretty interesting move, obviously, to 1245. We had a pull back, and then just yesterday, we had a really good advance in gold going all the way back towards almost 1240 on the upside. Let me just grab a chart right in here. It's 1234 right now at this moment. And the question I have, is this breakout going to happen or not? Obviously, you had a comment about the currency. What do you think was the influence?
Well, everyone was confused by today's move, and I wasn't confused at all because if you look, the Chinese yuan, it actually rose, and I've been pounding that drum for a long time that the gold priced in yuan is what you should watch.
The first move in gold was not actually driven by the yuan, but this breakout here certainly has a fuel. It'll be very interesting. Everyone watch whether this gold breakout happens because a squeeze above 1245 leaves 1300 on the upside. So what's number 3, Kev?
Well, back to China, we're going to actually see on Monday the Chinese PMIs are coming. And not only that, with all the trade tension between Trump and Xi Jinping,
Xi Jinping.
Xi Jinping, otherwise known as Xi Jinping in my world, he's delivering the keynote address at the Shanghai Expo. And so we haven't heard from him in a while, and this might be an opportunity for him to say something that might settle markets. So you keep your eyes open on for Chinese headlines. What do you think about number 2? What are you going to be watching?
Number 2, the FOMC meeting on Thursday. Listen, it was actually Powell's hawkishness, arguably over a month ago, that really started to kind of drive risk assets. Now, obviously, no one's expecting a rate hike. The market is not pricing in a rate hike this week. But what will the language come from the Fed? I mean, will they stay so hawkish, or with this kind of thing, will they kind of back off and take a little bit more? What's your take?
Well, I think that, as usual, I'm probably a little more bullish than you, and I watch for them to err on the side of dovishness.
All right, let's watch and see. That's and number 1, Kev.
Well, the big one is the midterm elections. That they're happening Tuesday, and to say that they're a big deal and that the market is on pins and needles about it is probably a huge understatement. We already have seen record turnout. This is going to be one of the biggest midterms in ages. I'm not even sure what the market wants anymore, what's built in. It's a very difficult situation to kind of handicap. What are you thinking in terms of what the market wants, and what do they think is going to happen?
Well, first of all, I think that there's going to be a surprise. Now, and I don't want to even say what it is, but what I do know is that the tensions between the liberals and the Republicans.
Okay, whoa. You're showing your Canadianness again there. Democrats.
All right, fine. The Democrats and Republicans.
Right.
But the point is that there's a lot of closet Republicans that won't ever say that they're going to vote Republican because they're scared of the flack they will take. But when it comes to putting the little X on the piece of paper, the swing votes are there. That's why that's why everyone was saying that Hillary had a 95% chance of winning and Trump won. And so whatever these poll numbers are saying, I'm not saying the Republicans are going to take Congress. I'm just saying it's not going to play out like everyone is saying.
So here's my prediction. You represent financial market consensus. And what I want to say about that is that maybe the Main Street doesn't think that the Republicans are going to kind of come out from the shadows, because if you look at the polls, the polls are showing that the Democrats should win, and
at least Congress.
And you go look at like 538 and all these guys that are the real big kind of predictors. They're all saying that the Democrats should do better. I think, though, that most financial market guys were burned in terms of Trump, and they were surprised. And I think there's a closet kind of belief out there that Trump and the Republicans have a better chance. So I kind of worried that if they don't win, that there might be more of a reaction than would have otherwise been the case, that there's more Republican win built into the markets than we expect.
You know what? The one thing I'll leave you with, rarely does something like this that is being so overanalyzed. I think that in this kind of, I guess, for lack of thing, is like a game theory of you building all the different scenarios of the different outcomes. I think that this has already been beaten so much that even the reaction that we get, whatever it is, will be very short-lived, and then the markets will go back to business. I think that they will offer a response. The response will be 24 plus hours, but I think that it's going to be shaken off pretty quick.
Okay.
Well, any final words you want to leave us with here,
I'm
Kev?
going to leave you with some trading wisdom, and this comes from my good friend Ari Pine that actually tweeted this, and it's actually a long-term capital management quote, and I kind of liked it. It says, "You can choose two of the three: trade large, trade leveraged, and trade illiquid, but not all three." And Ari, that's a great line. I kind of laugh about that. Thank you very much for listening. As usual, please feel free to give us any comments. We always appreciate it. And
as well, since we are actually putting this onto YouTube here for our first pilot, please follow our channel. Make sure that you follow us and subscribe to our stuff so that and help us build this brand. If you love the show, then help us make sure that this is a success. Anyway, thank you very much, everyone, for joining us. We're almost out of beer. We are out of beer.
That's great. And thank you to Thornbury Village Brewery for the ladder
What
run.
did you think of the beer? It was
I
good?
thought it was terrific.
It was a nice beer.
And for all those other breweries out there that want to get into our sponsorship, please reach out.
All right. Well, on behalf of Kevin, Muir, and myself, thank you for joining us, and have yourself a great day. Thanks, everyone.